Good evening, everyone, and welcome to the fixed income webinar for UTI Mutual Fund for the month of March 2023. We are meeting at a very interesting backdrop for the fixed income market. As Vladimir Lenin, the first president of Soviet Union, said, there are decades when nothing happens, and there are weeks when decades happen. And probably some of the weeks in March were something which were kind of historical. Uh, as you would know, since the rate hiking cycle started in the early part of 2022 by the global central banks, the financial market commentators as well as the economists have been waiting for an accident or a breakage, given the very, very aggressive monetary policy hiking cycle that we have seen in the last 6 to 8 months, especially if you compare it to the last 30, 40 years. There was a perception in the market that probably at some point of time, given the aggressive pace of policy normalization, we might see a housing market or a labor market or a financial market, uh, instability. And so far, all these sectors were behaving quite stably, and hence it led to a kind of a calm in the market, at least till the first week of March, that probably we are in a period of soft landing, and the rate hiking cycle will be quite aggressive. That got changed by the first week of March, and when on 10th of March, the California Financial Protection Institution, which is the regulator of Silicon Valley Bank, had to take over, and the FDIC was made the receiver for banks. We also had a couple of other bank failures in the US, and also one large European financial institution was merged to prevent any kind of instability in the European banking system as well. And post that, the interest rate expectations from the central bank drastically changed, and we will just discuss and what it means for the fixed income market, and what it means for us as investors, and what kind of products makes sense in the current market context. So just to kind of summarize, what are the factors that we are looking which will drive market going forward? One of the key concerns in 2021 and 2022 has been the rapid increase in inflation and henceforth inflationary expectations. As we move ahead in 2023, the base effects of high inflation in 2022, including the effect of Russia-Ukraine geopolitical tensions, those base effects will drop out. Secondly, the supply chain bottlenecks that we saw across the world, and especially emanating from China last year, they are now normalizing, and all the supply chain issues that we saw probably 2022 will not get repeated in 2023. The third point, and which was the point I was alluding to, is that a global financial sector crunch is right now underway across, especially in the advanced economies. In this kind of a tight financial conditions, right now banks are focusing on their own balance sheets, on cash preservation, rather than strong balance sheet expansion. And whenever such kind of phenomena happens, it typically leads to a slowdown in economic momentum, and hence slowdown in aggregate demand, which broadly leads to the inflation momentum also slowing down. What it really means as inflation starts to moderate in 2023, the interest rate outlook of central banks, especially of the advanced economies, also gets reappraised. Compared to earlier expectations where central banks were expected to hike multiple times during 2023, now we expect at a much more moderate pace of hikes, as well as probably the cuts for some of the advanced economy central banks will happen sooner than later. However, the quantum of rate cuts is still quite uncertain, because that will also depend whether inflation reaches or is close to their uh, long-term inflation targets. More importantly, for RBI, while we believe that the rate hike cycle is largely over and RBI could remain on a prolonged pause, we are still some time away from rate cuts, because it will lead a certain moderation in inflation to close to 4% for RBI to contemplate for rate cuts, unless and until the growth drivers materially slow down for India. And we will just discuss all of them in a while. So just to, as we were talking about how things have radically shifted in the month of March, if you look at the chart on the left hand side, based on Fed fund futures, this chart signifies the number of rate hikes the market participants are expecting to see from the Federal Reserve, and the blue line signifies the implied policy rate. So if you just look at it on 7th of March, the market participants were expecting 4 rate hikes by July of 2023, and the implied policy rate was somewhere between 5.5 to 5.75, compared to, if you look at 30th March 2023, in fact, the market is now pricing in a couple of rate cuts by end of 2023, and they were not really expecting any more rate hike from the Federal Reserve, given the tightness in the financial conditions due to some regional U.S. banking failure. So that's the kind of drastic change that we were talking about, which has altered the central bank policy path. If we look at the monetary policy action during March, so far what central banks are trying to do, they are trying to distinguish between financial stability and interest rate outlook. So what they were trying to do for financial stability, they were trying to give away liquidity lines. So for both, whether it's the US Federal Reserve or the Bank of England or ECB, they were trying to stabilize the financial system by providing adequate liquidity. However, they kept their interest rate reaction function quite consistent, as they have been doing for the last 9 to 12 months. We had the Bank of England, which hiked by 25 basis. We had the Federal Reserve, which hiked by 25 basis. And we had the European Central Bank, the ECB, which hiked by 50 basis in the month of March. If you look at the inflation prints across the advanced economies, the Eurozone was still experiencing 8.5% inflation. The UK was experiencing around 10.40 inflation, and even the US was experiencing around 6% inflation for the month of Feb. So right now, what the market believes is, yes, there have been rate hikes in the month of March. Probably in the next 2-3 months, majority of the central banks, at least in the advanced economies, are still likely to hike. But beyond next 3-4 months, the effects of the previous policy hikes, and especially the tightening of banking credit in some of these advanced economies, will become much more evident. And that's when these central banks will have to kind of go for a prolonged pause, and probably at some point of time in the later half of the calendar year, they might even have to go for some amount of policy normalization or rate, comments towards the rate cutting cycle to kind of stabilize the growth and inflation dynamics as well. If you look at this table signifies the movement in the 10-year sovereign bond yields in key economies. If you look at this table, although the yields month on month saw some change in most of the economies, especially the advanced economies, one of the notable features of this movement was that this was largely a sharp drop in yields in later part of the March, whereas the first half of the March, we saw sharp movement across US, UK, or Eurozone towards towards the 30-40 basis higher compared to February. But by the end of March, most of these bond yields came as market participants reset their reaction function going forward from these central banks. And one of the reasons we believe that probably central banks are on the last stages of rate hiking cycle is because economic activity has continued to slow down. So the left-hand chart shows the JP Morgan global manufacturing PMI. And if you look at this chart closely, since peaking somewhere close to May, June 2021, this chart has been on a downward trend, and especially the deceleration intensified in October 2022, and it has been on a slowdown, signifying that the pent-up demand that we saw post the pandemic, that's not really holding up. The right-hand side of the chart, which shows the global export volume as well as global export unit value. So if you look at the chart, which is the green line, which is the volume chart, if we see it is come down quite significantly. And if you look at the drop in the chart in the last 20 years, this drop can only be compared to the COVID period in Jan 20 and during the global financial crisis in January 2008. If you look at the blue line, which is the unit value, that is also showing a significant drop, kind of also indicating pricing pressures on the global trade activity. If you look at the financial conditions, this is also quite important. Today, financial conditions are tighter than they were in the later half of 2022. So if you look at the move, in the whole financial conditions from September 2021, you would see that financial conditions eased off a bit somewhere between September 22 to December 22. So, but again, they have gone up because of the ongoing credit crunch in the US economy. So, and that's the trade-off. So financial conditions are not just indicative of the liquidity or the headline policy rate. It's also a reflection of the kind of willingness of the financial institutions to lend to the real sectors of the economy. And because of the crisis in the banking system, those conditions are getting tighter, and overall credit growth in the US economy is slowing down, which makes us more confident that global growth activity continues to slow down, as well as the inflationary pressures that the global economy, as well as Indian economy, was experiencing because of high demand, that's also likely to slow down going ahead as well. This is the commodity and food index, since the last 5-6 years. If you look at the food index, that's continued to fall. So the whole spike that we saw post the Russia-Ukraine war has kind of come down, and YOY growth continues to be negative. Even if we look at the Bloomberg Commodity Index, which is a more representative of other metals and minerals as well, that's also been on a downtrend since the shock of Russia-Ukraine war. If you look at the index, it's come back to its early 2022 level. So this was the base effect that we were talking about, that just by getting it down, the 2023 inflation outlook looks much more comfortable. This chart is signifying the currency performance of various economies against the US dollar. And if you look at the Indian rupee, which is the highlighted portion, month on month, Indian rupee appreciated against the US dollar. One of the key factors for this appreciation was the change in policy outlook from the Federal Reserve. Now, with majority of the market participants believing that the Fed is close to its terminal policy rates, and probably the next move after this rate hike in the next 6 to 12 months could be a rate cut, and probably even the quantitative tightening that the Fed is undergoing at some point will also need to reduce. So that's leading to overall dollar depreciation across most of the currencies, and Indian rupee also continues to benefit from that. Coming to Indian trends, this is a quarterly projection of real GDP growth from RBI, and this is the as a table on the right hand side shows the quarter on quarter real GDP projection by RBI. So the broad drivers that RBI sees on this real GDP growth is the government's thrust on capex as well as private consumption holding up. The RBI expects that given that agriculture is doing quite well, even rural demand will pick up at some point of time, while government's focus on capex will continue to drive, uh, overall investment to GDP ratio, and hence provide that multiplier effect on the economy. Uh, why this is possible, given that in the last 2 years we are experiencing strong private consumption demand, it uh, it is it is likely that these growth projections could be revised downwards in the second half of this fiscal year, probably on slightly weaker consumption as well as weaker external demand. As we saw in one of the previous charts, the global economic momentum is slowing down. So while yes, the government capex can provide that impetus to growth, but private consumption can get affected from a weak external demand, and hence probably at some point of time, RBI will have to also look at the you know growth impulses of the economy through interest rate channel, and has to maybe will have to balance between inflation and growth. If we look at the domestic inflation rates, like I talked about, the base effects have started to play out. The headline CPI as well as headline WPI has started to come down. The normalization of supply chain pressures, the currency depreciation pressures that the Indian economy was experiencing in the second half of 2022 are now stabilizing. So the going forward, RBI is expecting inflation to average somewhere between 5.2 to 5.4% in the for the fiscal year 2024. Given that RBI is already at a headline policy rate of 6.5, we are already building in a reasonable real rate buffer of 80 to 100 basis points over the expected inflation. And hence, that's why we do not expect any more incremental rate hikes from RBI unless and until there is a drastic change in RBI's inflation estimates. If we look at RBI's commentary over the last 12 to 18 months, RBI has indicated that they are looking at a real rate of 80 to 100 basis, which basically means 80 to 100 basis over their expected inflation rate is somewhere they are looking to maintain their policy rate, which is the repo rate. Given that inflation is expected to stabilize around 5.4 in the later half of the financial year, we think this policy rate is adequate, given the view on inflation going ahead. The risk to the view is weather-related disruptions and possible deficient monsoon. But mind you, even in the past where there has been El Nino, so in the last 20 years, there has been El Nino for about 4 times. And inflation, especially food inflation, did not go up in all those periods because food inflation is also a function of how global food prices are faring. What is the kind of current reservoir levels in India are? What is the kind of spatial distribution of monsoon? What is the intertemporal distribution of monsoon? By spatial distribution of or the geographical distribution, if it's high in food producing areas, even then we still may be able to meet our food production targets. It also depends whether the monsoon, how well it is distributed across June, July, August. If the monsoon is well distributed, or especially is stronger in the months of June and July, it also leads to typically leads to better food grain output. So we will have to watch out for all these factors on how monsoon progresses to really assess the impact on food inflation. But mind you, as we saw in the previous chart, the global food prices are lower this time. So unlike some of the previous times when global food prices were also high and we saw the adverse effect of weaker monsoon in India, this point of time probably we will also have to look at global food prices, which are quite stable, and probably the monsoon will not have a very adverse effect on food inflation in India. Coming to liquidity, compared to the 8 lakh crore surplus liquidity that we saw in the early part of calendar year 2022, because of the seasonal outflow of currency, government cash buildup, and FX intervention, liquidity has come down to somewhere close to 2.5 to 3 lakh crores. We expect this liquidity to move to neutral, that is close to zero, by the end of 2000. To 23, given the usual seasonal outflow of currency, as well as the typical forex BOP deficits that India experiences. So at uh, some point of time, probably RBI will have to intervene to inject durable liquidity into the system, but that's still uh, some time away. Probably, a feature of Q3 or Q4 of FY24. This is how the sovereign curve has moved in the last 12 months. If we look at the shape of the curve, the biggest movement since 31st March 22 has come in the 1 to 3 year space, where 1 year curve has shifted by 240 odd basis, the 2 year by 200 basis, and the 3 year by 126 basis. This is also logical because if we recall last year at the same point of time, the economy was operating at a reverse repo rate of 335 compared to the current effective policy rate of 6.5%. So given the sharp adjustment in the effective policy rate from 335 to 6.5, it was the expected policy rate which kind of led to this whole reset on the short end of the yield curve compared to the 10 to if you look at the 10-year to 40-year part of the curve, which got reset but not with the same magnitude, because it's also a function of demand supply of these tenors, as well as a lot of this expected policy rate changes were already priced in somewhere close to 2022. So the 10-year part of the curve or the 15-year part of the curve, even last year, was pricing in some of these rate changes, and hence it was already at a high level. And that's why the correction which we saw has happened mostly in the 1 to 3 year part of the curve. This is how the movement has been across government bonds, corporate bonds, in the last 12 months. If we look at the 10-year bond yield, it moved from 743 to 731, whereas the 10-year corporate bond yield moved from 787 to 781, and the 10-year AA bond yield moved from 871 to 858. If we see in the month of March, yields across the curve, whether it was government bond, AAA, whether 1 year, 3 year, or 10-year, they all moved downwards as the whole reset in central bank expectations happened around the mid of March, and yields broadly reacted to that. Coming to the spreads, if we look at 1 year CD to repo rate spread, or if you look at the 3 year AAA PSU to repo rate spreads, they are broadly in line with their long-term averages, and they are still looking quite attractive. And why we are talking of 3 year AAA or 1 year CD spreads is because the maximum adjustment has happened in this part of the yield curve. So like I was alluding to in my previous slides, the 10 to 15 year part of the curve has largely remained stable even in the last 12 months. But it's the short end of the yield curve which has adjusted to the policy rate. And especially given the amount of supply which is expected in the upcoming 12 months on the government borrowing side, we believe it's the 1 to 3 year part of the curve, which is much more attractive in terms of risk reward. And especially if you look at a period where you still are not very sure about how the rate cuts and about the quantum of rate cuts from a risk management perspective, it's this segment appears to be much better, because even if you assume that uh, you know six half could continue for a while, uh, this segment has really adjusted, and hence this segment is providing significant accrual, and also is not very dependent on further rate cuts compared to the long end segment, which is typically expected to do well in rate cutting cycles. So to summarize, we believe that we have largely reached the terminal policy rates in India. The reason being that inflation is expected to moderate. The reasons being normalization of supply chains, the base effects dropping out, as well as moderation in aggregate demand uh, because of overall tightening in global financial conditions. Possibilities of further rate hikes are very low. Inflation will need to overshoot materially for RBI to consider incremental action. If, however, we have to distinguish between no further rate hikes to a scenario of rate cuts. Just because RBI is expected to pause for now, it doesn't mean that rate cuts will immediately start. That means that RBI will probably look at more decisive turn of inflation towards 4%, or at least high fours for before it starts to consider rate cuts. And hence we believe that the 1 to 3 year segment is most attractive in terms of risk reward, because that's where most of the adjustment has already happened. So typically when we look at fixed income, we look at focus on strategies which can provide a steady accrual or steady carry, compared to strategies which high duration strategies which can provide capital gains in rate cutting cycles. We believe since we are still some time away from rate cuts, we still would need better data clarity to consider rate cuts. It's better for investors to consider strategies that provide steady accrual, and hence investors who have a 6 to 12 months horizon are better off investing in low duration and money market categories, while investors who have more than 1 year horizon can look at actively managed intermediate duration categories. And by intermediate duration, we broadly mean strategies which are running duration somewhere between 1 to 4, because rate cuts, or at least the expectations of rate cuts, are still some time away, and it will require significant collapse in aggregate demand or significant reset in growth expectations, as well as significant moderation even in inflation expectations for market participants who start expecting rate cuts from RBI. If you look at the global context, as whether you consider ECB or the Federal Reserve, their current inflation or their current interest rates are at a much high level compared to their historical inflation, and hence when inflation starts to come down for these advanced economies, rate cuts can be much more aggressive for them in the next 12 months, because the rate hikes are also aggressive in the last 12 months. But probably for India, where the overshoot of inflation has not been very high compared to our inflation target, where RBI reaction has not been very aggressive compared to its overall trend, probably rate cuts for RBI also will not be as aggressive by the advanced economy central banks. And that's where the differentiation or the distinction we have to make between the reaction function of global central banks and RBI. On the last point of our view, there has been a lot of ink which has been spilled with the tax changes on mutual funds. And there is overall a view that given the taxation benefits are reduced for mutual funds, will mutual funds make sense in current regime? So just again to re-emphasize, uh, given the flexibility of liquidity in mutual funds, that is, one can redeem at a shorter notice compared to many other traditional fixed income instruments, which have a certain impact cost, whether in terms of penalties for premature withdrawal or some liquidity impact if you were to trade on exchange. Mutual funds are still one of the most liquid uh, fixed income instruments in terms of transmission as well. So if you whether you consider rate hikes or rate cuts, because mutual funds are market linked, the transmission in mutual funds happens much faster compared to some of the other alternate which we have in the market, and hence the attractiveness of mutual funds, especially fixed income mutual funds, still remain. And hence, we do not believe the impact of taxation should necessitate any major change in asset allocation for investors. It should mostly be focused on the risk appetite and the time horizon, or rather than just focusing on the taxation benefit. So that was it from my side. Happy to take up questions. Thank you.
Thank you, Anurag, for sharing your insights on the market trends and also covering most of the most asked question on will the change in taxation on debt funds, how will it impact investors, fixed income investors in particular. So with this, we will now take up the questions, and we'll try to cover as many questions as we can. And also, I would like to request investors to ask questions regarding related to the markets, fixed income market trends, or if you have any other queries, you can reach out to your RM or the nearby branch, and you can get the, or you can also mail us those queries. Moving on to the questions. Okay, so this question is related to the change in taxation benefit only, but since you have already covered how it impacts investors, but would like to understand what is the kind of long-term impact you foresee in terms of flows, and with some dent in demand side from mutual funds, do you see it will affect issuer or supply trends in the future?
So thanks for that question. So on the flows on the mutual fund space, I think it's still quite premature to really say that flows to mutual funds will decisively slow down, uh, etc., etc. I think yes, one of the attractive features of mutual funds uh, is really not there, but I think, like I said, so whenever we come into any fixed income instrument, what is the purpose of coming into a fixed income instrument? The purpose is coming into a high liquidity asset, which one can redeem at any point of time, which also provides stability in capital, which provides preservation of capital largely. Has that feature of mutual fund or a fixed income mutual fund changed? That's not really changed, right? The second feature, especially for investors who are tracking markets much more closely and who are taking active asset allocation calls, uh, which instrument in the in the fixed income space helps you express your interest rate views much more efficiently? That's largely mutual funds. So if one's view is that interest rates could come down in the next 12 to 18 months, which instruments on the mutual funds or on the fixed income side can give you an opportunity to participate in that interest rate cuts with added liquidity, with reasonable diversification across sectors, across issuers? That still is mutual fund. I mean, for an individual investor, it's still very inefficient to maintain a pool of bond portfolios. While you could invest theoretically in a single bond or a couple of bonds, given the tight issuer classification, given the tight sectoral limits that mutual funds have, you're also getting to participate in a very well diversified, uh, you know, pool of fixed income assets across money market, government bonds, corporate bonds, which is also giving you a reasonable amount of liquidity. And hence, we think the attractiveness of mutual funds still remain. So, even before there have been taxation changes, and many market commentators thought that probably fixed income mutual funds will lose their attractiveness, but the mutual fund industry continued to grow. We still believe that mutual funds today as also provides great value for patient investors, and we will like to see probably that how investors react to this new tax regime.
Yeah, thank you for your answer, Anurag. Moving on to the next question. Economic momentum in US is deteriorating due to banking crisis and tighter credit conditions. And some
Right.
reports are even suggesting that US is entering full-blown recession. So what, according to you, will be the Fed move in the upcoming meeting, and what will be the contagion effect on the Indian market?
Right. So I think there is still the next Fed meeting is in May, and there is still a lot of events which can happen between today and the next Fed meeting. But having said that, if you look at the current economic momentum, whether we look at the labor market, whether we look at financial conditions, whether we look at the PMI data, or whether we look at the consumer retail space, they are all pointing towards a slowdown in the next 6 to 12 months. So probably in the next Fed meeting, we expect Federal Reserve participants to acknowledge the slowdown, and also probably look at how give more clarity on their interest rate outlook, that how they are looking at the slowdown, and probably how they are uh, whether they look at this slowdown just like, if you remember, in 2021, when they termed the inflation as transitory. So whether they look at the slowdown as a strong slowdown or whether it's a mild recession, because probably that will kind of help anchor market participants' expectations from the Federal Reserve as well. Uh, Whether they go for a 25 basis hike or whether they hold is largely, I would say, immaterial. It doesn't really change bond market reaction materially, because the bond market is focused on next 6 to 12 months rather than just the next policy. Thank you.
Sure. So the next question is related to economic cycle, which keeps moving from slowdown to expansion, to late cycle and then again slow down, which triggered different interest rate responses from the central banks, from the RBI. Is the current linkage of economic cycle stage and interest rate cycle in sync, or excessively influenced due to the ongoing war between Russia and Ukraine and other macroeconomic factors?
Thanks for
So,
that question. Uh, so last 30, 40 years, especially since the 1980s, central banks globally mostly had to deal with the growth part of the equation, because inflation was largely stable, well anchored, and close to the 2% inflation target adopted by most of the advanced economy central banks. So they, uh, had to worry largely about interest rates on growth, and they could take action accordingly. The last 30, 40 years, the global economy also benefited from increasing globalization, and hence there was a general trend of improving productivity, and hence declining inflation. What's really happened in the last 2 years has been a moderate reversal of that. That one, the globalization has started to very, very marginally reverse, where because of all the supply chain disruptions as well as supply chain realignments because of the geopolitical tensions, whether you can call it between US, China, or Russia, Europe, etc., the supply chains are getting realigned, and hence there is some friction which is causing some higher inflation that we would see than usual. Secondly, because of high fiscal stimulus, given during COVID, and especially in the advanced economies, the aggregate demand uh, has seen a reasonable reset. And because of that pent-up demand, we saw those inflationary pressures uh, in the last 2, 3 years, and as well as a high growth phase. So, for the last 2 years, central banks had to deal with a scenario which was slightly higher growth as well as very, very aggressive inflation. And that really explains their very aggressive monetary tightening in the last 9 to 12 months. Uh, Going ahead, again, I think they will not be able to, especially the advanced economy central banks, I think will not be able to look at growth in isolation. They will have to balance between growth and inflation, because there is a difference between inflation coming of high eights and high nines, which we saw during 2022. So probably it will come from 8, 9% to 3, 4%. But the next move, which is that from 3% to 2%, that's where the central banks will have to be much more patient in the advanced economies. And probably it is still some time away that we are likely to see very, very exceptionally low interest rates that we saw during uh, the last 15 years. Coming to India, see, in India, we have been quite fortunate that we have been able to take growth for granted compared to advanced economies. What central bank has had to grapple with in the last 5, 7 years is establishing those inflation fighting credentials. If you look at the reaction of RBI since the high inflationary period of 2013, it's been largely to provide that macro stability anchor. It's been to largely kind of ensure that inflation remains well within the target and within the 4 plus minus 2 band. And as inflation starts to move towards 5 quarter range, which is expected in the end of FY24, the next step for RBI will probably be to ensure that inflation also starts to move towards close to 4% target, if not 4, but close to 4% target. And that's why we are not expecting aggressive rate cuts by RBI compared to other central banks as it waits for that inflation to get close to that 4% level.
Thanks, Anurag. Moving on to the next question. There have been talks on de-dollarizations recently. So how real is this? And if this actually happens, what
Right.
would be the impact on the global economy and especially in Indian context? Your views.
So I think this requires a seminar of its own, whether the can dollar can be really replaced, because there are too many moving parts and too many factors which go into dollar being a reserve currency for the world.
So we have
I
a
think in
topic for
every
our next seminar.
yeah, probably that. And but I still think that it's too premature to call for the demise of dollar. And because it's a it will be a very large reset in the way foreign exchange reserves of various economies are maintained and how global trade is conducted. If we look at 20, 30 years back, when euro came into being, there was an expectation that at some point of time, euro would replace the dollar. That's not really happened so far. So I think so. It's a very interesting world where we have digital currencies coming up, where we have other economies which are almost the size of the US economy, also trying to diversify. Uh, the trade in from dollars, but I think it's still some time away, and it doesn't really change the narrative on fixed income in the foreseeable future.
Sure. So the next question here is, considering that RBI downgraded the inflation estimates just by 10 bips, and there have been predictions of normal monsoons. However, El Nino seems to be a greater possibility. What does this
Correct.
mean for inflation? However, you have covered this question in while you were talking about the market insights, but would still like to take your take on this.
Sure. So the downgrade in inflation estimates by RBI is largely a function of downgrade of their crude oil price assessment. So if you would recall, in the Fed policy, they had assumed crude basket at $95 per barrel for India for FY24, which now they have estimated at $85, which is close to the current market price. And mind you, given that we also import a large part of our crude, at least as things stand right now, from Russia, which is at a reasonable discount as per various government and media reports. This $85 per barrel, as things stand today, is a more reasonable assumption. And that's largely the reason of downgrade in inflation assessment. As far as monsoon is concerned, if we look at the IMD forecast, which is the government agency, or whether we look at private forecast, both the agencies have given a higher probability of a slightly weaker monsoon. Just to again, put things in perspective, any monsoon which is, or any, sorry, rainfall, which is between 96% to 104% of long-term period average is considered a normal monsoon. Any monsoon which is rainfall which is below 96% of the long period average is considered a weaker or a deficient monsoon. And the probability of a rainfall being less than 96% has been highlighted even by the IMD. But like I said in my discussion on inflation, 2-3 things. El Nino doesn't necessarily mean a weak monsoon. There have been periods in the past where there has been El Nino, but the monsoon has still been normal. Secondly, even if you take the previous episodes where there was El Nino and there was a weaker monsoon in the last 20-30 years, the actual impact on food inflation, especially in the current globalized world, also depends on how global food prices are behaving. And like we also discussed when we saw the Bloomberg Commodity Index as well as the Food Price Index, global food prices and global commodity prices have drastically corrected from the one-time shock we saw during the initial stages of Russia-Ukraine war. So global food prices have drastically corrected. Secondly, what also depends, if you look at the distribution of monsoon in India, is the northwest region and the eastern region, which are the large producers of food grains in India. So we also have to see the spatial distribution of monsoon in India. Where exactly are you getting the deficient rainfall? So it depends on that. The third is, and that's the problem with statistics, right? That if you get excessive, if you are more than 100 in 1 month, and if you are, let's say, 80 in 1 month, even then the average can be 100. So we'll have to really see how rainfall is split between the 3 monsoon months, which is the June, July, August, especially if the monsoon is on the higher side in the months of June and July. That can lead to a higher moisture content in the soil. And hence, even if we were to see a slightly lower or a deficient rainfall in the month of August, it will probably not pose a very material risk for food grain production in India. The fourth reason, and which is also very important, more than 50% of our crop area is irrigated. So we also have to see how the water reservoirs are are running compared to their long-term period average. And if you look at the water reservoirs, they are running reasonably comfortable over their long-term period, averages. So we have water stock for irrigation available in India right now. Global food prices are lower, much lower than the initial period that we saw in 2022. And we also are yet to see the distribution of how, the distribution of monsoon, one regionally, and then even within the intra-season of June to September. So and we also have to see how the government manages the food grain supply. So if like we saw in the last 12 to 18 months, the government has provided free food grains to the vulnerable section of the society. Wherever necessary, government has cut duties on edible oil, etc., to ensure that edible oil prices also remain well controlled. So it's a combination of all these factors. So it's very difficult to say right now that whether monsoon will have a outsized impact on food inflation in India. If you look at RBI commentary, if you look at the commentary from private forecasters as well, there has been no definitive kind of assessment on how monsoon can impact. Yes, that's an upside risk, and that's why we are more constructive on the 1 to 3 year space, even on the duration segment, because even if, let's say, there is an upside risk to inflation, probably that delays rate cuts from RBI, right? Because it may not mean more aggressive rate hikes, but probably delays rate cuts. And that's why this intermediate duration can do better and can provide a better steady accrual in this period of uncertainty.
Sure. So moving on to our next question, which is regarding the borrowing expectations that have come from the government. So we see that the first half of the government borrowing is skewed towards the long end side of the bonds. So how do you see it can impact the options which are coming up? And also, do you see that there will be some headwinds or on the borrowing numbers might change? Your views on this?
Sure. So on the first part, which is the government borrowing program is slightly skewed on the elections, the, the disinvestment program of the government, uh, and also how the government is able to manage its expenditure. So it's very difficult to say right now whether the government will overshoot its fiscal deficit target, because there are again too many moving parts, both on the revenue expense on the expenditure side. Uh, uh, so at this point of time, I think it will be better to take the borrowing number as it is. But even on that borrowing number, I think we could see some steepening bias on the yield curve because of the heavy supply pressures on the longer end of the yield curve. Thank you.
So, and the next question is on the credit side. So, what is the house view on the credit risk strategies, double A or the lower side? Your views.
Right. So on the credit risk side, I think in the last 2 years, as we have seen, as various corporations have deleveraged, given the benefit of high, liquidity, low level of nominal interest rates, and overall movement to a more formal economy. If you look at the leverage ratios of, especially of large and mid-sized corporates, they are much more healthier than compared to the pre-COVID levels. So yes, the starting point or the fundamental of many of these corporations are much more stronger. Having said that, the risk reward is still in favor of quality strategies compared to credit heavy strategies, because the spreads that we see on most of the credit oriented strategies are still quite low and really do not reward the investors for the kind of liquidity risk or the credit risk that they could end up taking with these kind of strategies.
Sure. The next question is, it is commonly said that an economy is as good as its banking system. We have seen this, at the time of some of the financial crisis like GFC. Now, when the banks are struggling to stop kind of deposit outflows, what are your views that it may lead to tightness in the credit markets and a weaker economy?
I think that pertains more to the probably to the temporary situation that is existing in the US right now, rather than India. So in India, we are not really experiencing any kind of outflows from the banking system as such. So the Indian banking system is still quite robust. As far as globally things are concerned, I think sitting out here, it's still difficult to take a view on overall banking system. But broadly, one of the reasons for the outflow from the banking system is movement towards money market funds, and that's what I was alluding to. And so that mutual funds do not lose their attractiveness just because of taxation changes. The transmission that funds can have in periods of interest rate changes are much more efficient than some of the banks. So that's also a signal, because what's happening in some of these economies is that money market funds are giving much better yields than some of the bank deposits, which are still quite sticky. So that's just a reflection of how mutual funds are much better uh, pass-through vehicles of any interest rate changes compared to traditional fixed deposit or fixed income instruments. As far as the stability of the banking system is concerned, I think things are too premature. There are a couple of issues that we right now many of the advanced economies are facing. One is, of course, the asset liability mismatches of many financial institutions. The second is the effect of this aggressive interest rate hikes on their investment portfolios. And third, as and when they try to maintain their balance sheet strength, and when they stop onward lending, the effect on highly leveraged corporations, which could again lead to some kind of a asset distress cycle going ahead. And that's what makes us more constructive on overall interest rates. And that's what leads us to believe that Fed is close to their hiking cycle.
Sure. The next question is there any impact on the fixed income markets due to gold price movements?
I'm sorry, I didn't get the question. Gold price movement.
Yes, right. That's right.
So gold has a certain weightage in CPI and core CPI as well. So probably some slight impact on inflation if gold price starts to move on the higher side. But we do not see, as things stand today, we do not see more than 5-10 basis points impact on inflation in the long run because of gold prices.
So we have questions keep coming from the viewers, but in the paucity of time, we will take maybe 2 or 3 more questions before we conclude the webinar. So the next question is, recently, growth forecasts have been cut for India and other global economies by IMF. So what is your take on this?
So I think that cut in growth forecast compared to the previous economic outlook in January is largely a reflection of expected weakening in external demand due to tight credit conditions in many of the advanced economies. So like I also alluded to in my previous slide when I was presenting outlook on growth, that probably at some point of time RBI may have to revise their growth forecast downwards, because as consumption starts to take a hit because of weak external demand. So probably I would agree with the assessment that growth outlook. So I will not get into the numbers, but if you look at the trend, I would agree with the trend that compared to 3 months before, the current trend of growth looks on the weaker side because of the tight financial conditions that we are experiencing.
Sure. So the next question is, since the interest rate has been peaked out, kind of peaked out, what should the investors of floater rate funds should do now? Is this category still attractive, or should investors take some view on exiting from their investments and moving their funds to some other strategies?
Sure. So as we have alluded before, floating rate funds category is a heterogeneous category where one needs to look at the benchmark of that particular floating rate product to really assess the risk reward from that category. As far as UTI floating rate fund is concerned, it's a high credit quality oriented, low duration strategy. So investors who are looking at a low duration space, which is broadly duration being maintained between 6 months to 1.2 years of duration, investors need to look at least a UTI floating rate with that mindset. As far as overall view on floating rate bonds or floating rate papers are concerned, see, ultimately, any fixed income instrument, whether it is fixed rate or floating rate, the price movement of that instrument is also a function of the net duration of that particular bond. So for the floating rate fund as well, one needs to look at the net duration of the fund to assess the risk reward from that particular strategy. And hence, we are constructive on UTI floating rate because that's a low duration, high credit quality, strategy. And given that we are constructive that interest rates have largely peaked out, and if you look at the 1 year part of the curve, that's still yielding us 90 to 100 basis over the expected policy rate. So if an investor has a 6 to 12 months view, this strategy is quite suitable for investors because they get to earn a decent over the current policy rate, as long as investors have some tolerance for some intermittent volatility.
Sure. So last question for today's webinar. External events have been weighing on the market sentimeters. And as we have entered the new financial year, what are the risks that will be carried forward from the last fiscal FY23 that investors should be watchful?
So investors, I think, who are investing in very high duration strategies probably will need to be watchful of any significant changes in inflation expectations. So right now, yes, the inflation expectations are that at some point of time, inflation will moderate close to various inflation targets. And probably if that were not to materialize, very high duration strategies, despite their better yields, may not be able to compensate for the mark-to-market risk that they are carrying. Second part, on the fiscal side, if you look at the tax collection assessment or estimates made by the government, they appear to be quite aggressive compared to the pre-COVID era. And in case there is any disappointment on tax collections, and let's say there is a higher welfare spending either due to deficient monsoon or general economic slowdown, then probably the fiscal deficit assumptions that we are kind of maintaining right now again could be challenged. And again, one could see higher supply of bonds than what we are envisaging right now, and which again could be counterproductive for very high duration strategies. And hence, investors need to be mindful of both fiscal as well as inflation risk. And hence, they need to allocate more diligently and more prudently.
Thanks. With this, we come closer to the end of our webinar. I request our viewers to share their feedback on the link that is displaying on your screen, and closing comments from you.
Thanks a lot, everyone, for joining on this webinar. Hope you find this session useful. Please feel free to reach out to your relationship manager for any queries that you have on our views or any of the products. Thanks a lot. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.